Hello. So thanks for attending today's session. This is myself, Suleiman Ravel, from Wealth Focus, and on the line we've got Justin Braitling, who's the Portfolio Manager and Director of Watermark Funds Management. Hello, Justin.
Good afternoon.
Just before we start, Justin, I thought I'll just give people a little bit of background as to where we're coming from, and then I'll hand over to you in terms of getting a bit of background as to how your fund intends to operate and how you've been managing money with Australian Leaders Fund. And then we'll probably have a couple of questions towards the end as well. Just for people who are listening in, on the right-hand side of your screen, you should have a little box from GoToWebinar. And now on there is a few different options. One is questions that you can ask. So if you click on that drop down, you can ask some questions there as we go along. I'll be viewing those, and I'll ask Justin those questions as he presents. Okay, so just going on to ourselves. So as most of you are aware, we've got two sides of the business. We've got Funds Focus, which has been the newsletter that we write, which basically gives you insights into what we think is going on in the market and opportunities, and a lot of the time we provide some analysis on the investments that we've provided access to. We've done an analysis on Watermark Market Neutral Fund as well. That should be on the original email, or if you go onto the website fundsfocus.com.au, you can access that there as well. The other thing I need to point out as well is everything we say within this presentation is general advice only, and shouldn't be considered personal advice. If you, you should go and seek individual advice to your circumstances, then you should read the prospectus. The other side of the business is Wealth Focus, which is a full advice service where we sit down with you and tailor portfolios to what you're actually trying to do. Now, just to give you a bit of insight, we have been using Australian Leaders Fund quite extensively within our portfolios for the last few years, and we've been very, very happy with Justin's performance over that period. Yeah, so that's all I've got to say before I hand over to you, Justin. Just give me a second. I'll just pass it over to yourself. Have you got it on your screen, Justin?
I think so. I'll move through the slides, and hopefully it works.
Yeah. In fact, actually, I think a good starting point as well, Justin, is just maybe if you give us a bit of background as to yourself and the money you've been managing over the years, and how you ended up with what you were doing prior to Australian Leaders Fund.
Sure. Suleiman, I'll move to the first slide and talk through that. Has that come up about Watermark?
Yep, that's right. Yep.
Excellent. Okay. Yeah, great. No, thanks for that. So my background, I started in the industry in 1990 working with Bankers Trust. I was there for 12 years managing as an analyst and managing portfolios both in Australian equities and in international equities. I left BT in 2003 and set up Watermark, and we listed ALF in 2004, soon thereafter. ALF was established as an investor in the larger Australian companies with an absolute return focus. That was the strategy, and then over the years we've really developed that strategy further, and we have incorporated the hedging tools that are such an important feature of our process now, principally around our short selling and our short portfolios. So that's a bit of my background. In terms of the manager, we're a small team. We're looking to make a couple of additions, but we'll keep it a small team. We've got two funds. We've got ALF, which is the listed LIC that's almost in its 10th year. We'll have our 10-year anniversary next year, Suleiman. Hopefully you'll be there. And we also have a wholesale scheme, the Watermark Market Neutral Fund Trust, Now we launched the trust back in August last year, and it's up 24% over the 9-month period. So this new company that we're launching here will employ the same strategy as the Watermark Market Neutral Fund Trust. So if you're happy, Suleiman, I'll just move through the presentation now. Moving on to the next slide, you can see what sets Watermark apart from traditional funds. And we really are trying to offer an alternative to traditional managed funds. You know, in our mind, the vast majority of managed funds are kind of doing the same thing. You know, while there are hundreds of them, they're all employing the same investment process, which is constructing portfolios that track the market. And
what specifically led you to launch this fund as opposed to, I know you had a capital raising on Australian Leaders Fund in March, which we participated in, but what was the background to actually wanting to launch a market neutral fund specifically?
Sure. Well, we'll show a slide in a moment which takes you through the different strategies. But in the long-short space, there are a number of different strategies that are gaining traction with planners and advisors. ALF is what they call a variable long-short fund, and we'll go through that. And this is clearly a market-neutral fund, which is a different strategy again. But there's a lot of demand for market-neutral funds which have no market risk, which are fully hedged structures, and so there's no market risk. So what you're able to do is you're able to access the strengths of the stock picker in adding value through security selection, but without having to take on the risks incumbent in investing in the share market. And so that's what we're offering here. It's a very different strategy to ALF, and we're very excited by the strategy and the outlook for this company. It is very different to ALF, and there's a lot of demand for these market neutral strategies, and there's very few funds available. You know, the large ones in this space are closed because there has been so much interest, and that's Regal and Benelong. You may be familiar with those funds. There are very few that are open, and fewer still that have a long track record in managing long-short portfolios, which we have. So, you know, there's a real demand for these strategies, and there's no product out there. So that's why it's an opportune time to come to market.
I think just for people who are unfamiliar with long-short strategies, the most notable that I'm aware of is Platinum, which I think a lot of retail investors would have heard of in Australia, and that's kind of along the lines of what you're doing with Alpha, isn't it?
That's right. You know, when you look at a long-short manager, it's important that that the manager's adding value on both sides. So he's good at investing in companies, and he's good at shorting companies as well. You know, some of those other names you mentioned, Suleiman, you know, they're good on the long side, not so good on the short side. What you'll find when you look at our numbers, and we'll show you the numbers in a little while, that we're adding value on both sides of the ledger, and so that's important when you're looking at a long-short manager. But Platinum is a long-short manager. You know, he doesn't really promote himself as a long-short manager, but that's exactly what they are. You know, we're the same. He invests in international shares. We're investing in Australian shares. But it's a very powerful structure, and we'll take you through that in a moment. It allows us to do a lot more than a traditional managed fund in terms of adding value through stock selection, but also because shorts are a hedge, we were able to manage market risk far more effectively than a traditional fund as well. So we'll go through that in the next couple of slides if you like, but that actually just touches on the key strengths here in this slide. We're an absolute return manager, so we only buy and sell companies we think are mispriced. Now the traditional institutional manager, and that's 90% plus of the money that's being managed out there in Australian equities is in the institutional space. They employ a relative return model. So the fundamental difference is around risk. Their assessment of risk is the prospect of underperforming the market. Our assessment of risk, as earth-shattering as it may seem, is the prospect of losing money. And I know which one resonates more with me. It's very clear. You know, losing money is something that I worry about a lot more than underperforming the market. But it's a fundamental difference.
So Justin, why is that? Why are they focused on underperforming the market rather than an absolute return?
Yeah, sure. I mean, you never lost your job for delivering a result which is in line with everyone else. You know, and a lot of the philosophy behind managed funds really stems from the academic literature that was written in the 60s and 70s around market efficiency. You know, the academics were saying you can't outperform the market, so you kind of got to replicate the index. And then from a business perspective, you know, the managers want to hug the index because, you know, you're not going to lose your job for delivering a result in line with the market. If you deliver a result which is materially different, it's good if you have a big win, but if you have a big loss, then, you know, your business is potentially at risk. So what they end up doing is just huddling around together, tracking the market, tracking the index, and trying to add a little bit of value over and above that. And they do a good job of that. That's what they're designed to do. They do a good job. We're trying to offer something that's clearly different. And it really does come down to your understanding of risk. You know, we see risk as the prospect of losing money. They see risk as the prospect of underperforming. And so it is a fundamental difference, and that's first and foremost the major difference in our strategy. The other key differences, though, really stem from our ability to short sell. And shorts really are just another source of profit. You know, there are opportunities not just to invest long in shares and buy undervalued shares. Opportunities exist also to sell short overvalued shares and to profit from that. And what we're doing is using our experience as stock pickers to be able to take advantage of both opportunities, not just to buy undervalued shares, but to sell overvalued shares as well. So that's the shorts as an additional source of alpha. And then
I think
shorts.
what might be useful there, if I just explain that for people who don't know what shorting is, you're basically taking a position, you're selling shares without actually owning them. So you're making money if the share goes down in value.
Yeah, sure. I probably should elaborate on that a little bit further. Short selling has been around for hundreds of years. It's a very deep market pool. You know, the securities lending pool is a very deep liquid market, and the shares we're borrowing them from the large institutions. You know, the AMPs and Colonials and BTs of the world. They're happy to lend their portfolios out, and they lend. It's a very deep liquid pool, and our prime broker, who in our case is UBS, they have arrangements in place with all those investors, custodians, and pension funds to lend their shares out, and we borrow those shares and we sell them. And then when we sell them, we generate proceeds. And this is the bit that people don't understand about shorts. They don't understand that shorts are a source of funds for our investment portfolio. So when we sell short, we generate proceeds, short proceeds, and that gives us additional funds to then go and invest in the companies we like. So that's how it works. It's a very simple process. It's been around for hundreds of years. You know, it's really just the other side of the trade. You know, if you invest to go long, if you borrow to sell to go short, it really is just the other side of the trade. Except we obviously can't short stock that we don't own, so we have to go and borrow it from someone else. And the cost of borrowing those shares is very low. It's about 0.8% per year. So it's a very low cost of funds for us, and that's exactly what we're doing. We're using our skills as stock pickers to access a source of funds to fund our investment portfolio. It's a very attractive way of funding an investment portfolio because of the hedge. Because shorts are a liability, the stock we've borrowed, it's a liability, and we then go and invest those funds in an asset, the other shares we own, and so the asset and liability, there's a natural hedge there, which makes it a very attractive way of funding an investment portfolio. So that's it in a nutshell. Solomon, shall I move to the next slide?
Yep, go for it.
So if you look at our investment process, what we're trying to offer here is the same security selection process that you might see from one of those big institutional funds. Now, you might think we were a little disparaging in our commentary around those institutional funds. What they do well is stock selection. They're very good on stock selection, identifying mispriced securities. And what we're trying to employ here is the same process in terms of security selection. Where their model fails is in portfolio construction, because they construct portfolios that track the market, that track the index, and they dilute the upside in their portfolios by doing that. So we avoid that step. In addition to that, though, we construct a second portfolio, a short portfolio, in addition to our investment portfolio long. So we're constructing two portfolios. That's an important point of difference. But our process in the way we go about looking for shares to buy and shares to sell is exactly the same as the institutional model. Now, this model is robust. It's a very predictable process, and the big institutions have developed it well. What we're trying to do here is employ the best in class in terms of that same process, what you might see from one of those better institutions like a Schroders or a Perpetual. I came from BT, that's the process we've got here, and really offer that same process because it's very clear, auditable, disciplined process that everyone understands. And that's why there's no secrets here in how we go about select companies to buy and sell. What is different about our process is in portfolio construction, in that we are an absolute return manager, so we don't dilute the returns in our portfolios by trying to reconstruct the index, and we construct two portfolios, taking advantage of the opportunities to short sell. And the shorts there's some significant advantages in offering that short portfolio because of the hedge, which we've kind of covered off already. So,
am I correct in saying then, so your way of looking at the world is you've got your long portfolio, which is the shares that you buy because you think they're going to go up in value, and your short portfolio is basically the shares that you're selling because you think they're going to fall in value.
That's right, that's right. So very simply, that's exactly right. We look to profit on both sides of the ledger, and so if you look at the next slide, our qualitative scorecard, you can see the two portfolios and the types of companies we're looking for. But ideally, we're looking to populate our investment portfolio, our long portfolio, with companies that have superior economics, are well managed, and have valuation support. And our short portfolio, we're looking to populate with weaker businesses, with weaker management that are overvalued. Now, we profit to the extent our long portfolio goes up and our short portfolio goes down. But even if our short portfolio does not go down, we still profit to the extent that our long if we take that short portfolio, the funds we've raised from selling those shares, and we put that money into our long portfolio, we're still ahead. So long as our long portfolio outperforms our short portfolio, we've profited from the additional return we achieve from reinvesting those short proceeds into our long portfolio that's outperformed. So long as our long portfolio outperforms our short portfolio, this strategy is always going to be ahead. It doesn't matter whether the shorts go up or whether they go down. The only thing that really matters in this strategy is that the long portfolio of companies we like outperforms the short portfolio of companies we don't like. And so that's a misunderstanding around short selling. People think, the market's going up, so the guys that are short selling, are hurting. That's not the case. So long as we've taken that money from selling those securities and we put it into companies that are also going up, and if they've outperformed the shorts, then we're ahead. So that's the way it works. You can see here, so ours is very much a fundamental investment process. It's a bottom-up process built around detailed research of Australian industry. And for all the companies we investigate, we compile a qualitative scorecard. And you can see here our scorecard and the key qualitative factors that we appraise each and every company on. And so each of the companies in the universe, we give them a score based on this scorecard. And that might be a useful template for your own investigation of Australian companies. And so taking that scorecard, if you look at the next slide, you can see that we rank the investment universe based on those qualitative scores from most preferred to least preferred. Our process is pretty simple. What we're looking to do is to invest in those companies that rank well on those qualitative scores. So they are the stronger businesses that are well managed. We look for opportunities to buy those companies when they're undervalued. Similarly, we look to sell those companies, those weaker businesses that are poorly managed, on occasions when they're overvalued. And that's how we construct our two portfolios. So looking at the next slide, you can see here our dashboard. And this basically just demonstrates to you the style bias we're introducing into our portfolios. So we are true to label. Our investment portfolio is populated with stronger businesses that are well managed and undervalued. Our short portfolio is populated with weaker businesses that are poorly managed and have less valuation support than our investment portfolio. Now looking at the next slide, you can see here the different strategies in the long-short space. And I'm sure you've heard of a number of them before. But basically the different strategies are all just different combinations of the two long and short portfolios. So the companies in the long and short portfolios remain the same. The portfolio structure remains the same. What differs with the different strategies is just the relative size of the two portfolios. And you can see here the three different key strategies. ALF is what they call a variable long-short fund, so we can adjust the amount of market risk we retain. And the amount of market risk you retain really is just the relative size of the two portfolios. So you can see in the top right-hand corner, you can see how the long portfolio is bigger than the short portfolio. And the degree to which it's larger, the net long position, if you like, reflects our net exposure to shares. So you can see in this case here, this is a fully invested portfolio where you're net long 100% of your capital. You can see in the middle panel, you can see a market neutral structure, which is the company we're listing currently. And you can see here the size of the long and short portfolios are of equal value. So this is a fully hedged structure. And in effect, the long portfolio has been funded from the proceeds of the short portfolio. And that is quite separate to our capital, which is retained in the bank as cash. So capital sits in the bank, nice safe place for it to be, and then our long portfolio is just funded from the proceeds of our short portfolio. And then you've got a short fund down the bottom where all of your funds are retained in cash, so you net short the market. So the point being here though is, in long short, all we do is construct the two portfolios. That's our job. But then you've got the different strategies which really just give you different market risk outcomes. And the one we're offering here today is a market neutral fund where you have a fully hedged structure and no market risk. So looking at the next slide, let's have a look.
Actually, just before we go on to the next slide as well, can you give us an example of types of companies that you think are going to struggle in this environment, and basically ideal for shorting?
Yeah, sure. And there are a lot of natural pairs, where one company is benefiting very much at the expense of the other. You might think of an example of an Ainsworth Gaming versus Aristocrat is a good example. Or, using international shares, and we invest in Australian shares, but international shares, think of Apple versus Nokia, where Apple have taken Nokia's position in the handset market. And so, there are a lot of natural pairs, but and there's just tons of them. We sport for choice, and that's what we have here. We have opportunities to profit from these natural pairs, whereas a traditional manager doesn't. So just take an example today. In fact, I can't wait to look at it. I can't even see. I'm not in front of a screen, but what the new news shares are trading at, 1480. So that's well below our valuation. But there's a good pair. We'll look to buy the new news portfolio of publishing assets and digital media assets, and we could short the, and that's something we're doing today, short Fairfax newspapers. And so you've got a natural pair there, but with the publishing piece of new news is quite small. But the News Corp holders internationally will sell those publishing assets or the new news stub because they have a negative view on the outlook for newspapers, as do we. But there are digital assets. The digital assets make up the bulk of the value of the new News Corp. So we were happy to own those digital assets long, and we'll short the publishing assets of Fairfax. So there's a great pair.
Okay.
So just let's have a look at how our portfolios have gone. And our flagship fund, ALF, you can see on the next slide, has outperformed all the other LICs by quite some considerable margin. Now the new fund that we're launching here is the Watermark Market Neutral Fund Limited. The code will be WMK. We're looking to raise up to 120 million shares via the issue of $120 million via the issue of 120 million shares with attaching options. So it's the same package as the recent placement that we did in ALF that did so well. Now, of the 120 million shares, we've got a Cornerstone who's taking 20 million shares. We've put aside 20 million shares for ALF shareholders as a priority offer, and then we've got commitments for financial planning from financial planning groups for 10 to 15 million shares. So that's half the offer. The balance, the other half of the offer, we're looking to issue via a broker firm offer, and the JLMs, Morgan Stanley and Macquarie will lead that process. So if you have a relationship with one of those brokers, or Suleiman will be able to coordinate that for you. We'll get a priority allocation.
Contact ourselves on that side of things. Thanks.
Suleiman's your point person there. But the ALF deal was tight, and so it's probably sensible to get an allocation. The structure you can see here is the same as the wholesale fund. It's a market neutral strategy. The benchmark is the RBA cash rate, and we'll explain why that's the case in a minute. The fee structure is 1 in 20, which is the same as ALF. We're targeting 12%, a 12% return, and the yield, we'll hope to return a large portion of that to shareholders via dividends, and we're committed to a 5% dividend in the first year. We're targeting a 5% dividend
in the first year. I think an important note on that as well, when were you saying that you're expecting to pay your first dividends?
So we'll pay our interim dividend probably in the new year, so that'll be in February, March, and then the final dividend February, March of next year, obviously, and then the final dividend will probably be in September of that year. So you'll get 5% or 5 cents in the first year. Now, we'd like to think the package of shares and options will trade at a premium, a bit of a premium. NAOS, which is the only other recent listing, that's traded at a premium, the package, and it's never traded below the dollar value. So we'd like to think you'll see a repeat here. So now there's another important development in LICs that you should be aware of, and this is good news for existing investors in LICs. Bad news for anyone who wants to bring a new LIC to the market, because basically the door is going to be closed with FOFA. It's going to be very hard to list a new LIC once the FOFA legislation is in place, because issuers aren't going to be able to pay a handling fee. So consequently, it's very good news for LICs that are already up, because there's no new supply coming through. There's not going to be any new supply after this one, so if you're interested in LICs going forward, there's only one way to get set, and that's to buy on market. So that's good news for LICs. Now let's move to the next slide, which gives you just a simple snapshot of this structure. And it is a very simple structure. There's nothing complex about it. For every $100 of capital, that $100 goes on term deposit and sits in the bank. So your capital is safely in the bank, and it sits there for the duration of your investment. Separately to that, we then go and construct a portfolio of shorts of the same value, $100. We sell those securities because we've borrowed them from our stock lender. We go and sell those securities, and we raise $100. And then we invest that $100 into our portfolio of long securities that we think will outperform. And so that's the structure. The investment portfolio, you can see, is funded from our short portfolio, and you can see the return profile down the bottom. We benefit to the extent we obviously receive the interest on our cash at bank, plus we benefit to the extent that the long portfolio outperforms the short portfolio. And you can see the return that we're targeting there. And that's how we come up with a 12% return. Now when you think about, and Suleiman, you might have seen this slide, but when you think about how this strategy compares with your traditional managed funds, it's very different, very different. And, you know, for those of you who are investors in the traditional managed funds, you know that most of them track the market, track the index, and they target index plus type returns. And so the return profile is pretty simple. Your capital is fully invested in the share market and fully exposed to the market return, market forces. And so most of your return is explained by the return delivered by the market. Over and above that, the manager will add value through stock selection, and he adds a little bit of value on top. Think about it like a cappuccino. You've got your long black, which is the market return, and then you've got the little bit of cream, which the manager adds on top. Now our strategy is very different in that because your capital is not exposed to the share market, your capital sits in the bank earning interest, and that's a double-edged sword. You don't have the risk in the market falling, but you also don't participate in the market gain. So you don't get the return from being exposed to the asset class. Your capital is sitting in the bank.
So just in plain English then, are you saying that if the market goes up or the market goes down, it shouldn't really have an effect on your portfolio? It's really a case of if you can pick the longs that you've got, that they go up more than the shorts that you've got.
That's all that matters. That is all that matters. It doesn't matter. You can see here. It doesn't matter whether the market goes up or down. It will have no impact on our returns. It really doesn't. You have no net exposure to the asset class. So it makes no difference whether the market goes up or down. The only thing that matters is how much value we are adding as stock pickers. And we're able to target a much thicker layer of cream. And the next couple of slides will describe why. But that's important. You don't have exposure to the market return, and that's a double-edged sword. You don't have the risk, but you don't get the reward either. So this strategy may underperform a very strong market. Now, we don't think we're in an environment where shares are going to deliver strong returns. So we don't see that as a significant risk to this strategy. But at the same time, you'll see in a moment, we think risks in investing in shares are quite high, and you obviously don't carry those risks in this strategy. So if you look at the next slide, this gives you a sense of why we're able to target much higher returns. Now, this slide, it takes a bit of explaining, but it's very worthwhile. This is a distribution of value in the share market. So this gives you a sense of the value opportunity in shares. And what you can see is the market in the main is efficient. Most companies are fairly valued. The market is pretty efficient. Otherwise, we'd all be a lot richer. Isn't that right, Solomon? And we're not. And that's because the market is pretty efficient and it's actually not that easy to make money. But there are a select group of companies on the right-hand side of the distribution that are undervalued. And you can see also, as with any statistical distribution, there are companies that are overvalued on the left-hand side of the distribution. Now, investors, and when sorry, was someone asking a question?
No, sorry. Carry on. I'm just agreeing with you. It's just got quite noisy at this end, so I'm trying to use the mute button, so I'm not interrupting you too much.
Okay, great. Now, you can see on the right-hand side of the distribution, that's where the value opportunity is in the market. And we're no different to every other institution, the better ones. We're trying to identify those shares that are undervalued. Now, a stock picker worth half his salt will be able to construct a portfolio that is at least 5 to 10% undervalued and should deliver a 5% return each year. Now, and we're no different. Now, where our process differs from the institutions, the better institutions, remember, employ the same model, and we like their security selection model. They're good stock pickers in the main. There's some good stock pickers out there. But what they do next in constructing portfolios actually destroys value. And that's because they view risk differently. So what they do next is they then go and add to that portfolio of shares, which is 5% undervalued. They go and add all these shares in the middle, the fully valued shares, and also some of the shares on the left-hand side of the distribution, expensive shares, because they construct portfolios that track the market. So even if BHP, to take an example, and it's not, but to take an example, if BHP was on the very left-hand side of this distribution, if it was the most expensive stock in the world, pretty much every institutional investor would hold at least 4 or 5% of their capital in BHP because they have hard limits around the active bets that they can take in constructing their portfolios, because their portfolio has to track the market within certain tolerances, which is what they refer to as tracking error. And so that's the step we avoid. We avoid adding all this dross in the middle, which what it does, it actually dilutes the upside in your portfolio. So instead of having 5% embedded value in your portfolio, they dilute the return in their portfolio to more like 2 to 3%. And coincidentally, that's exactly what the best of them deliver. They deliver 2 to 3% outperformance over the medium term. So we avoid that step. So we're able to preserve the value in our portfolio. Our process
now,
actually...
Justin, I'm just sorry. I'm just conscious of time from your end as well, because I know you've got to go on to another presentation at Macquarie. Can I get you to skip onto slide 18 and just in terms of what you've just been talking about, actually showing the returns that you delivered within ALF, and then how it would follow through onto Watermark.
Yeah, sure. Okay, sure. Okay,
That
let's
was your
just jump
financial
to
year gross returns for ALF.
Yep, sure. Okay, if you look at slide 18, you can see how the two portfolios have performed for ALF. You can see how our long portfolio and our short portfolio has performed. Now, if you recall, we profit to the extent our long portfolio outperforms our short portfolio. That's all we have to do. We just have to construct a portfolio of companies we like that outperforms or does better than a portfolio of companies we don't like. And what you can see here, in every year, the long portfolio has outperformed the short portfolio. And that's what's important here. It doesn't matter whether the portfolios go up or whether they go down. It doesn't matter whether the market goes up or whether the market goes down. The only thing that matters is that green bar outperforms that red bar, and it has every year. So if we jump to slide 19, you can see here how...
Just staying on that slide a moment, Justin, just got a question on that as well. Because I think when I've looked at the presentation on this, I think it can be quite confusing. So the red line is your short portfolio, but say, for example, in 2008, even though that's a negative number, you actually made, where are we, about 25% on your short portfolio, is that right?
No. It's not that confusing. So let's look at 2008. Okay, so our investment portfolio fell by almost 20%, our long portfolio. So you think, okay, we've lost money. Wrong, because our short portfolio has fallen by 28%. And the difference between the two, 10%, is basically that is because for every dollar of capital we have a dollar long and a dollar short. Because they all are of the same size, a dollar, dollar, the difference, 10%, is basically our pre-tax, pre-fees return on equity. And if you look at the next slide, you can see that's what the blue line is. That's the blue line. And you can see in every year we've delivered a positive spread. We've added value because our longs outperform our shorts. So this strategy has never lost money in the 6 years. We've also put in this slide the grey bar, which is the market. And you can see the market has fallen 50% of the time over the last 6 years. It's fallen 3 in the last 6 years. Now, importantly, you can see that our returns in this strategy are uncorrelated with the market return. And that makes perfect sense. We have no net market exposure, so there's no reason why there would be any correlation, and there isn't. And that's important from a portfolio construction perspective. What you're looking for is you're looking for an asset, or not an asset class, because this asset class is fully hedged in this structure. You're looking for an investment strategy that is uncorrelated with the market and ideally has not lost money. And that's exactly what you've got here. Now the orange bar you can see is the ALF net return. And you can see, once again, this strategy is uncorrelated with ALF because ALF has market risk. So ALF is much more highly correlated with the market than this strategy. So that's important. So this is very different to ALF, and it's important because this strategy has never lost money and it is uncorrelated with the market. And that makes it very valuable in your portfolio construction. So Solomon, I think that was it. We finished off with the ALF results, and we've all seen them. They're very strong, and hopefully you can see the value that we've added. The timetable is important. We've opened the offer up. It closes, or the broker firm offer closes on the 25th of June, so next Tuesday. So if you want a firm allocation, then Solomon can help you out there. Otherwise, go into the general offer, and that'll close on the 5th of July. So yeah, I know
we've asked investors to come to us by the end of tomorrow.
Okay.
Just to give us their interest on this. They can come and ask us for some afterwards, but that's first come first served. If we've got any extra allocation left over. Excellent.
And the stock will settle DVP, so that makes it easy for the planners. So that's the presentation. It's a great strategy. I think we've put together a good company with a good board. We've got the track record to support it. So and we think LICs will trade well in the FOFA environment. and you'll make money on the package. So that's pretty much it in a nutshell. Thanks for your interest, and Solomon, we'll definitely stay in touch. But we do have time for a few more questions if there are any other questions.
Well, I just had just one main, in fact, two questions actually. One was, you know, are you comfortable that the market is large enough for you to run this mandate? I mean, you've got this, and you've also got Australian Leaders Fund. So it's quite a bit of money that you're running now, and that was my main concern as well myself.
Sure. We've got lots of headroom, Solomon, to ease your concerns. If you look at Regal, and they're probably the largest long-short manager out there, they're at $1 billion, and you know, whilst they've closed, you know, they've closed at a level where they still think they can deliver good returns for their investors. You know, you don't just close because you can't make any money. You've reached a size where you don't have the ability to deliver good returns. I mean, they've found that in their strategy, they think at $1 billion, you know, that their returns are under some pressure, so they've decided to close there. Now, with if we're successful in raising the $120 million here, and all of our options are exercised, then you know, we're still less than half of that. So we've got lots of headroom in our strategy to make attractive returns for our shareholders.
Okay, and then just one other thing. So, in fact, this is a question from Ms. Lung, which was, would the insistence of this remaining market neutral compromise your performance in a strong trending bull market?
Yes. Now, thanks for that question. As that previous slide highlighted, you know, it's a double-edged sword. We don't have the market risk here, but we don't get the free kick either from the market return. Every dollar that we generate here is hard-earned from our stock selection. So we don't get the free kick from a strong market. And so in a strong market, we will struggle to keep up. In our wholesale trust over the last 9 months has actually outperformed a strong market. That's because we've had outstanding stock selection. But it's hard. You know, it gets harder. The stronger the market return, the higher the market return, the harder it is for us to keep up. But we've got to do it through blood, sweat and tears. The hard way, we don't get the free kick from having exposure to the market because we don't have any exposure to the asset class here.
Yeah. I mean, in fact, I think a good point worth noting is how your wholesale market neutral fund performed last month. I seem to remember that it was quite spectacular.
Yeah, sure. So the wholesale market neutral fund was up 7% last month, and the market Solomon was down 4%, I think, wasn't it?
Yeah. Yeah, in fact, all odds 4.3 or something like that. Okay, and also, just a last point as well. Can you tell me when your options expire as well?
Yeah, sure. So with this prospectus, the options expire in December 2014. So they have a long duration, and I should note we have had 4 option issues in ALF, and you can see how well that company's performed. The investors like the options. They get it for free. It gives the investors the opportunity to increase their exposure to the fund if they want to put more money into the company. They can exercise their option. Alternatively, if they don't want to increase their exposure, they can sell the option. It obviously has value. And the ALFOs, the ALF options, are currently trading around 10 to 12 cents. And the options here would have considerable value as well. Or alternatively, they can just let the options expire. So we find it's the best way to grow the business, the most equitable way to grow the business, and the investors love them. And you know, we've had 4 successful issues already in ALF. So you get an option with the share as well.
Okay. Well, and they're exercisable at $1 as well. So if your share price is $1.30, it's $1 they can exercise that on those.
That's
ones.
right. That's right.
So I think the final note is really just to give our view with this type of strategy is that we'd allocate somewhere between 5 and 10% of the client's portfolio. So just to give you an idea of, you know, where we would see investors using this within their portfolios. But thanks for your time, Justin. Much appreciated. And yeah, if anyone's got any questions, they can drop me an email afterwards, and I'll be happy to answer them. Thanks a lot.
Solomon, a pleasure as usual, and thanks for your interest, everyone.
Thanks a lot. Bye.
Thank you. Bye.